Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to the latest episode of the Prime Property Finance Podcast with me, Gareth Morgan. In this episode, we're going to talk about the impending potential rate drops coming into 2026 and whether it's a good time for you to buy a property, whether you're remortgaging or whether you're looking to hold tight, and just understanding whether you should fix your rate now or wait until potentially rates drop next year and the pros and cons of that. So let's dive into it. And thanks for listening. Welcome to this episode. Interest rates have climbed over the last few years and they've reduced a little bit earlier in this year, and property affordability has been stretched. And now you're sat on the fence thinking, should I wait until 2026 when rates might finally fall? The problem is that could cost you more than you think in missed deals, in higher monthly payments, or even losing the possibility to buy your dream home. Now imagine this, you know the pros and the cons, you understand the timing, you make a move that's right for your situation and not just based on headlines or hype. In this episode, we're breaking down the conversation around falling interest rates, when we could see them drop, what that means if you're buying or remortgaging, and how to avoid costly mistakes by waiting for too long. So what are we talking about? Whether now is a smart time to remortgage or buy a property, or whether you should wait for potential lower rates in 2026. As things stand, the current interest rate of the Bank of England is 4%, and we're expecting another announcement today. So why should you wait? Well, getting it wrong could cost you thousands. If you fix for too long, you might miss out on a lower interest rate. If you wait too long, you might lose money today by paying a higher interest rate. And when is this relevant? So at the end of this year now, as we come to the close of 2025, many people's fixed rate deals are coming to an end, both on their residential home and on their investment properties. And as people predict a rate drop, then, it's all over the news. Then we need to kind of consider what our options are going into 2026. And who is this for? Ultimately, any homeowner or investor that has a mortgage ending within the next 6 to 18 months. Landlords weighing up their portfolio expansion or first-time buyers trying to target the market. Ultimately, this is for anyone who has a mortgage or is looking for a mortgage within the next sort of 6 to 18 months. So the first things you need to understand are, where are we now in the market? Base rate, like I mentioned, is 4%, the Bank of England base rate, which is higher than it has been. But now that inflation's kind of dropped a little bit, that has come down. This, as we are expecting an announcement later on today as to what the Bank of England is going to do this time around. Our anticipation is that the interest rate will remain the same. We've got the impending budget at the end of November, which has the potential to be quite scary. So we expect it to kind of stay the same this month, and then we'll see what happens next month. In terms of actual mortgage rates, in terms of residential rates, residential 5-year fixed rates are sitting around the 4% mark at the moment, which is pretty similar to the Bank of England base rate. And buy-to-let interest rates are sitting on a 5-year fixed. They're currently sitting at somewhere between 4.5% and 5% on a personally held interest rate. So, pretty steady rates at the moment. So we just need to kind of see, I think we've reached a peak in terms of where we're going to be in terms of interest rate highs. And hopefully that'll settle back down now, much under the 5% mark over the next kind of 12 to 18 months. So what's the forecast for 2026? So some of the experts predict the Bank of England base rate could come down a fair bit in 2026. If inflation's under control, then there is talks of the Bank of England base rate coming down a bit further. And so whether that comes down to sort of 3.5%, that might mean mortgage rates come down closer to 4%. But that remains to be seen, and it's really difficult for us to predict that. But ultimately, if the base rate comes down, then that potentially means lower fixed rates and lower tracker rates, depending on inflation, the global markets, and of course, lender margins and competition. So yes, rates may fall, but not dramatically overnight. So what do you need to do to consider your current deal and timeline? So if your current deal ends within the next 6 to 12 months, then timing is everything. What you can do, you can usually lock in a new deal 3 to 6 months in advance of your current deal ending. So you don't want to leave it too late. And the advice would always be get a rate locked in, because you can always, if the rates do come down, then you can always get a lower one before that deal completes. The risk is obviously staying on your standard variable rate, coming off your deal and going on to the standard variable rate means that you could be paying a rate of 6 or 7%. So if you want to just sit on your hands and wait until rates fall just a little bit more, that could mean paying thousands extra in the meantime. And so I've had a client who's been sat now on a small portfolio, waiting to see what happens. He's already paying thousands over what he needs to be, and just waiting and see. And every time we check in to see where the rates have come down, the rates haven't really changed. And whilst the interest rate and the Bank of England rate has kept coming down, the mortgage rates haven't really changed. And so if he had just done this sort of 12 months ago, then he'd have saved thousands of pounds in wasted interest. So you need to make the calculations around what you're going to pay extra on standard variable rate over just locking into a deal now and paying potentially more than what it might be later on next year. If you're looking to buy a property, then you need to just focus on affordability and not on the headlines. Ultimately, trying to time the property market is like trying to time the stock market. It's almost impossible. One of the key old adages is don't wait and buy property and wait. Because property prices over time will always go up in value. And if you wait and try and time the market, you'll never get it right. And, interest rates are just one of those affordabilities. So if the deal works for you now with current interest rates, then it's a good time, buy the property and not the interest rate would be the key takeaway there. And then if you start thinking strategically and not using speculation, short-term fix gives you a flexibility if you believe rates will drop, whereas a 5-year fix, for instance, gives you stability and peace of mind. Investors or homeowners on tight budgets often make payments based on certainty, will benefit, on payments of certainty rather than on small savings. So ultimately, choose a product that matches your plan and your affordability and not just on your gut feeling of what might happen in the market. And as interest rates come down, there will be a return to see potentially more tracker options. Now, in the past, there's been a big conversation around, do you want a tracker rate? Do you want a fixed rate? Understanding the pros and cons of a tracker versus a fixed and the benefits of it. But actually, in the market, in terms of product availability, there aren't loads of tracker rates available. So that conversation's become quite moot of late. And we're seeing the majority of our clients taking fixed rates for that reason. But as the competition comes more into the market and rates get squeezed a little bit, we might see the introduction of trackers. And then you've got to look at the risk and reward of getting a tracker versus a fixed rate and what savings that could make for you. And then finally, really you need to sort of model your options. So look at the difference between the 2 years and the 5 years on both fixed rate and trackers and see where your break-even points are. Plan ahead. What other impacts will it have on the property and your plans? Can you afford interest rate rises? What if the rate goes down? Great, those savings will make. But what if the rate goes up? And how does that compare to what you'd be paying now? So can you afford those changes? And is it worthwhile? So, like we said, waiting for the perfect rate is like waiting for the perfect weather. You might miss the best opportunities while you're watching the forecast. So, ultimately, make the right decision for you based on your circumstances. Don't try and second guess too much. And if the deal works for you now, then just crack on and do it. Hopefully that's been helpful. And if you've enjoyed and that you found that helpful at all, then please like and share it. Many thanks. Thanks for listening, and hopefully you enjoyed that episode. And if you have some decisions to make on what type of deal that you want to fix into or get a tracker on in 2 years, 3 years, 5 years, or potentially longer, then please get in touch with us if you'd like some help with that. One of our team can run through those options with you and work out what the best deal is for you and your circumstances. And if you like and share the podcast, that would be great. And we'll see you on the next episode. Thanks for listening. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.